We ended the week with a continuation of the 2025 sell-off, with the S&P 500 down another 2%, and we're now close to 10% down from the all-time high. And that's just the index. There were tons of companies that sold off big time on Friday. For example, you had Lululemon down 14%, Domino's Pizza down 5%, Alphabet down 4.8%, Netflix, Amazon, and Meta down 4%. These are some high-quality big tech companies selling off. In my personal dividend growth stock portfolio, I was down over 2% on the day with a loss of $4.2 thousand. Now, if you're new to investing, that kind of $4,000 loss may scare you off. However, it's important to recognize that daily fluctuations like this are all part of investing. And if you're going to be investing in the stock market for decades, there will be days far worse than this. In fact, some of the greatest investors ever, like Warren Buffett, have gone as far as to say that you shouldn't own common stocks if a 50% decrease in their value in a short period of time would cause you acute distress. His longtime partner, Charlie Munger, has said, if you can't stomach 50% declines in your investment, you are not fit to be a long-term investor, and you deserve the mediocre returns you are going to get. Now, Charlie's known for being somewhat colorful in his language, but what do they actually mean when they say this? They mean that when you're invested in the stock market, prices can often fluctuate significantly. And you may have individual holdings of yours down 5% in a day or 50% in the span of 6 months. And over the long term, even the S&P 500 index can be down significantly. It was down 50% during the dot-com bubble, 57% during the great financial crisis, and it was down 30% in a matter of weeks during the pandemic. However, the mistake in all of these scenarios would be to sell and get out of the market. And as we zoom out, this recent market sell-off is pretty normal behavior. If we go back to even just 2022, we had a 23% market sell-off, and prior to the pandemic in 2018, we had an 18% sell-off. These corrections and even crashes are normal behavior. And if you're going to be investing in the stock market over a long time horizon, you need to get your emotions under control and not make stupid decisions during these sell-offs. Today, I'm going to share exactly what I'm doing right now during this 2025 sell-off. And let me start off by saying, I don't know what's going to happen with prices over the next few months. We may bottom out and grow from here, or we could sell off another 5, 10, 15%. What I do know is that I've been building a dividend growth focused portfolio where I have an ownership stake in very high quality companies. These are companies with reliable and growing profits that pay a portion of it out to me as a shareholder. For example, this month I've earned $458 in dividends, which I reinvested to buy even more shares during the sell-off. And during market sell-offs like this, you can actually buy into some of these great businesses at a lower valuation. And personally, that's what I've started to do. And I'm actually pretty excited about it. I just had my largest month of buying in probably more than a year. So today I'm going to share the 3 stocks I just bought and why. I'll dive into it and give a stock analysis on each. And if you stick around to the end of the video, I'll give you an updated look at my overall portfolio. And I'll even share a big purchase I just made in my Roth IRA. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. And by the way, if you want to use the tool I show throughout the video for tracking my own portfolio and analyzing stocks, it's all available at dividenddata.com. And I have a very important announcement that the March Madness sale, where you can get 50% off the annual membership for life, that sale is over at the end of March. So if you're watching this video, you probably have less than 24 hours to redeem the sale. The link is in the description and pinned comment of the video. It's all available at dividenddata.com. There's a 30-day money-back guarantee, so no risk in trying it out. So let's dive right into what stocks I've been buying. So in my dividend growth portfolio, which is the one I update every single month on the channel, I bought $3,795 of stocks this month. And as you can see, those $2,000 into one, a little over $1,000 in one, and a little over $500 in one. And then in my Roth IRA, just this Friday, I bought $3,400 of a stock. And I'll give you a hint, that was the same as stock number 1 in my dividend growth portfolio. So let's dive right into it. Throughout the month, I bought 13 shares of Alphabet, ticker symbol GOOGL. This is the parent company of Google. That was at an average cost basis of $160.26. And then this Friday in my Roth IRA, I bought 22 shares at $154.75. And this brings Google to 5th place in my dividend growth stock portfolio with 87 shares. That's 6.5% of my total value. And I am down 10% overall. However, I am very happy that Alphabet is going down in price as I can start to build my position in the company. This is a newer position of mine. And why am I happy about it? Let's go and analyze the stock. So here on our stock analysis tool, you can see visualizations for the financials of Alphabet stock over the long term. And first, as an overview, you can see that they just hit all-time high in earnings per share for $2.15 in the latest quarter. And based on EPS over the trailing 12 months, they currently trade at a 19.2p ratio. And this is a very low multiple for a dominant big tech company that is growing as fast as Alphabet. And if we go and look at their key financials, you can see that they're growing top-line revenue with a 10-year compound annual growth rate of revenue per share at 19.14%. Free cash flow per share just hit an all-time high as well, and the 10-year CAGR free cash flow per share is 21.3%. It's a highly profitable business with a great balance sheet. They have negative $70 billion of net debt, and they just started rewarding shareholders with a dividend payment, and I think the company is set up to be a dividend growth stock for the future. And I've done full stock review videos on Alphabet if you want to know what I think about their business model and potential disruption risk around search, and how I think each of their business segments will evolve. But today I just want to focus on the top level stock analysis. And if we go and bring this down to the 5-year for both earnings per share and stock price, people may see this, 17% sell off from the top for Alphabet, and they'll think, oh, it's not down that much. It could sell off much, much more. And yes, it could. And they might point to the 2022 sell off and say how it got down to $86 a share. However, you can't look at price in isolation. With investing, you need to actually look at the earning capacity of the business and also the expected future growth. So during that 2022 sell-off, Alphabet had decreased their earnings per share from $1.53 in a quarter all the way down to $1.05 a quarter. That was over a 31% decrease. However, if we go and look at Google's earnings today, they just hit all-time high earnings per share of $2.15. So they have more than doubled their earnings per share in the past 2 years. So with this 2025 sell-off, Google stock is actually trading cheaper in terms of valuation based on earnings per share today than it was during those 2022 lows. We are also not coming off of declining earnings. And so far, there is no indication that Google stock earnings are going to go down. In fact, all of the signs point to the exact opposite of that, whether it's outlook, recent performance, and just thinking about how their core business segments are operating. Or if we go and look at the earnings per share estimates among Wall Street analysts, they're expecting double-digit earnings per share growth every single year through 2029. By the end of fiscal 2027, they're expecting full-year earnings per share to hit $11.80. That would mean, based on today's stock price, Alphabet stock would be trading at a 13p ratio. So you could buy one of the best big tech companies in the world with an extremely strong business at just 13 times 2027 earnings. And as we go further out to 2029, where there could be a higher margin of error, analysts are projecting $16.38 of earnings per share, which would put the stock at a 9.4p ratio based on today's prices, which is kind of crazy. Now, again, this is just my personal opinion. I've done a deep dive on Alphabet stock and looked at all their business segments. And personally, I think this will be a company that continues growing for decades to come. Now, there may be some down years along the way and some slower growth years that are like only 5%. And by the way, let's go look at those businesses. I asked the AI analyst to show me Google's revenue by segment. I think in the future, Google Search will continue to be a highly profitable business and continue to grow. They just grew revenue 13% year over year. I think YouTube will be a far bigger business. They just grew revenue 14% year over year. I think Google Cloud will be a much larger business. They just increased revenue 30% year over year. And in other bets, they have Waymo, which I think will be one of the leaders in self-driving. However, that can be very difficult to project. I think Google's valuation makes a lot of sense, even if you are only looking at Google Search and YouTube. So I think the financials of Alphabet are very strong. The only negative thing I see is that they're increasing their capital expenditures a lot in 2025. This is the same with other big tech companies like Microsoft because they're investing in more AI data center capacity. I dive a lot into this in my full Google stock review video. And although this increased CapEx puts a lot of pressure on Alphabet in order to find some return on investment in that AI spend, I do think there's a lot of clear upside as well. And from a technical standpoint, you could really go on for hours about this. The one that can make better models to improve their search results for users. They can also use AI, deep learning, and machine learning to improve their advertising targeting, which Google fundamentally is an advertising business on Google Search and YouTube. This is actually one of the areas where you're seeing the best return on investment for AI. This is also being seen in Meta's advertising business. At the same time, there is risk of new competition in the AI space, such as ChatGPT. Again, I dive into that in my full stock review. The other big risk for the company is that they're facing an ongoing antitrust lawsuit. However, it completely is up in the air what happens with that. But overall, I think now is a great time to buy a high quality business at a fair price at a minimum, you could argue that it's a discount. For example, if we just look at the price targets among Wall Street analysts, the consensus target is $204.58, which implies 32% upside from today's price. The lowest price target on Wall Street is $182. So personally, I hope Alphabet continues to sell off and I can keep building up my position. I view this as a core part of my dividend growth portfolio going into the future. The second stock I bought was Microsoft, ticker symbol MSFT. I bought 3 shares at a cost per share of $381.43. I have 110.42 shares at a current total value of $41,830. And so far I have a 51% total return. That's up $14,000. This company pays me $366 a year in dividend income, and they've been growing this dividend by 10% basically every single year. This is another stock I have been very excited to buy. So this already is a core position in my dividend growth portfolio, but I haven't really bought it at all since this 2022 sell-off. So I was excited to just finally pick up a few shares at what I think is a fair stock price, and I'll dive into that. Overall though, Microsoft is one of the best big tech companies in the world. Since 2015, they've been growing their earnings at a reliable and high rate, and that's why you've seen the stock price take off. Revenue per share is growing at a 10-year compound annual growth rate of 12%. Free cash flow per share is growing at a 10-year compound annual growth rate of 11.95%. Similar to Alphabet, they have a great balance sheet. And that's the thing with these big tech companies. They're some of the best businesses in the world. And it's amazing how fast they continue to grow at this size. From the dividend growth perspective, Microsoft has a much longer history of paying dividends, and they also increase it every single year. It's a sustainable dividend with a 30% payout ratio based on free cash flow and 24% based on net income. Analysts are projecting double-digit earnings per share growth in the coming years. And I think this is very fair when you consider the business segments they're operating in. The consensus price target's $496 a share. That implies it's 31% undervalued. But that's just the opinion of Wall Street analysts. In my opinion, I think this is an example of a high-quality company selling at a fair valuation right now. And I'll show you what I mean by doing a quick DCF valuation here. This is discounted cash flow. You can find these on dividenddata.com. In the AI analyst, just type in any stock and then DCF valuation. And then if you scroll down, you can get to this calculator and you can edit and fill in the data. Now you can see with the default information, it put the implied share price at $277. But if you scroll down, we can see that it's kind of inaccurate because they're assuming 0% growth in 2028 and 2029. So let's say we put 15% revenue growth in both those years, which I think is probably likely. Then without changing anything, we're up to $357. And by the way, if you don't know how these work, it's all based on projecting the future years of free cash flow the company will generate, and then discounting the sum of those cash flows all the way back to today. And you can do that by either assuming a terminal growth rate in the years beyond 2029, or based on exit multiple. So basically what times free cash flow you think the company will trade at in that 2029 year. So just looking at this calculator, the other notable thing I'm seeing is that they're expecting increases in capital expenditures. That would be up to $94 billion a year in 2029. If you don't know, Microsoft's core growth business is their cloud infrastructure. So they're investing a ton in AI data centers. And if we go and look at the annual cash flow statements, you can see that in 2024, they had $44 billion in CapEx, which was a huge increase from prior years. In prior years, it was in the 20s. But in the latest quarter, they hit $15.8 billion alone. So that would imply at least $60 billion this year. So we definitely should expect higher capital expenditures in the future. However, I have listened to some interviews with the CEO Satya Nadella, and he has voiced how important it is to stay rational in that CapEx investment, and basically that they're not going to go crazy with it. They want to keep it tied to the business realities on the ground. So I did make the change that basically it kind of poops out around $70 billion of annual CapEx. I think that's somewhat reasonable. And now we're moving the implied share price up to $414 a share. That's assuming you have $155 billion of free cash flow in fiscal 2029. And the company trades at the same multiple they do today, 28.45, which I think is probably likely. So that's a long and somewhat detailed way of saying that I think Microsoft's trading at a pretty fair price right now. This is with, in my opinion, relatively conservative estimates. Microsoft is a core position of my dividend growth stock portfolio, and I think it's a high quality business to own in the future. So if we get another 5, 10, 15% sell-off, I'll be adding to that position. The third stock I bought was another big tech company. I bought 2 shares of Salesforce at a cost per share of $284.10. This is another company I just added to my dividend growth portfolio within the last 6 months. It's in the middle of the pack so far. I am down 7.6% after this recent sell-off, and I'll likely keep adding to it at these prices. I'll go quicker with this one. I do have a full stock review video on Salesforce stock as well. This company has seen just fantastic growth in earnings per share. However, it does trade at a relatively high multiple, and it has just a fantastic history of growth. You can see revenue per share has grown at a 16% 10-year compound annual growth rate. The number one concern right now for investors in the stock is that revenue growth is starting to slow down. It was only 10% year over year last year, which is still very good. This company has also become a free cash flow powerhouse. Their free cash flow per share is growing at a 26% 10-year compound annual growth rate. And you can see it grew by 32% this year and 53% in the year prior. And unlike Microsoft and Alphabet, Salesforce is not investing at all into expensive AI data centers, so their capital expenditures are very constrained. So this company is just going to pump out lots of free cash flow. And that's why they just started paying a dividend. And this will be a dividend growth stock going forward. They just had their first dividend increase, which was 4%. And this dividend right now is a small percentage of their cash flows. It's a 12% free cash flow payout ratio and 24% GAAP EPS payout ratio. This is another company that's expected to have double-digit earnings per share growth in the coming years, and it is undervalued at today's price based on the consensus price target among Wall Street analysts. And the common theme among the three stocks I bought is that they are all companies with very strong business models, great financials, and a clear path to continued earnings growth well into the future. And that's a very important part of investing. So going back to the beginning, I'm excited by the 2025 sell-off because I can increase my position into some of these high quality businesses. And we need to remember that when you're investing in the stock market, you're getting ownership stake in real businesses. And when you follow a dividend growth investing strategy like me, these companies pay you a portion of their profits no matter what's happening with stock prices. That can be a lot with some of my high yield stocks like the Altria Group, or it can be less with some of my low yielding ones like Visa and Microsoft. But all of these companies increase their payments on an annual basis. So for example, if Microsoft does another 10% increase, I'll be getting $400 a year in dividends. And then if they do another 10%, I'll be getting $440. And then another 10%, nearly $500, and so on and so on. I also reinvest all of these dividends to acquire more shares, giving me a dividend snowball effect. So when we take an overall look at my current portfolio, it's valued at $206,000. I have $131.9 thousand invested. This is a total return of $74.6 thousand or 56.56%. This portfolio has basically existed for 5 years, and I'm regularly adding new money every single year. It pays me $4,700 in annual dividend income. That's $1,175 every quarter, $391 every month, $12.88 every day, and 54 cents every hour. And I'm excited for April coming up because that's one of my bigger dividend months. And this dividend income is the backbone of my portfolio, and it will continue to grow over time. So I hope you found this video to be valuable. If you did, make sure to leave a like and subscribe to the channel. And if you want to use the stock research tool I showed throughout, it's all available at dividenddata.com. Our March Madness sale is about to end, where you can get 50% off your annual membership and lock in that discount for life. This is the best deal we ever offer, and you have to join right now. That deal is about to expire at the end of March. Click the link in the description and pin comment of the video. With that said, thanks for watching, and I'll see you in the next one.